But for physical, it's not really going to make much of a difference because if the spot price falls, premiums are going to rise. They're going to pay the same price anyway. So if you're looking to stack, keep doing it. If you're looking to initiate paper positions, I would hold off until probably after delivery day next week.
Rafi Farber discusses several factors that could impact the silver market. These include high open interest in silver contracts, which could lead to a short-term decline in the spot price, but likely won't affect physical silver due to rising premiums. Additionally, he talks about U.S. sovereign default risk and the potential for a temporary default and a new treasury market, which could drive several markets into chaos.
I do see some danger of a decline in the spot price from the open interest we're at. Open interest means the amount of silver contracts that are open, really. And we are at a high in the open interest. We're at about 160,000 contracts. We haven't seen that level since April 2022. And that could lead to a short-term decline in the spot price. I don't think this will apply to physical silver because premiums tend to rise when the spot price declines like that due to open interest smashes. And if you watch Chris's video with Andy Sheffman and Bill Holter this week, you'll know that the supply of junk silver especially is very tight. And premiums in junk silver, I think, are about 26% now, which is historically very high. And it looks like a bottom in premiums are in. Also look at U.S. sovereign credit default risk, which is the highest it's been even before 2008. This tends to happen every time the debt ceiling becomes a political issue again. And at this point, you have both Republicans and Democrats with humongous egos, neither of which are actually interested in cutting spending at all. It's all a show. So it depends how far they want to stretch it and make the other side bleed or concede, or I don't know what these people are actually thinking, and they're all just a bunch of clowns, but it's possible like that the debt ceiling could lead to a temporary default in the treasury market, which would drive several markets a little bit crazy. And it's possible it could happen. And by the credit default risk, the market is saying there's a high chance. We'll see what happens.
The Federal Reserve predicts a recession for the first time ever, with the New York Fed's recession probability rising to its highest level since 1981. Additionally, the U.S. government only has $109 billion left, which will last about 2 weeks, so the debt ceiling will have to be raised. Silver deliveries are also expected next week.
This one's a big one. The Fed predicts a recession for the first time ever. I did some research into Fed minutes going back to 2008, and I will just take Mish's word for it because Mish is the one who wrote this sentence that it's the first time they ever predicted a recession. But going back to 2008, they've only mentioned the word recession twice in any of their minutes. And they only mentioned as recession as a possibility. I think the first time was like December 2008, which everything was already collapsed by that point. So yeah, when the Fed predicts recession, it's something special. And we also have the New York Fed recession probability rising to the highest level since 1981 when interest rates were 20%. The German people are getting abused by their government again because the two remaining nuclear power plants just cut their service and shut down when the Germans are already paying astronomical prices for their electricity. And after this shutdown, prices are rising by another 45% for some providers. It's all crazy. German food prices are rising at a faster than 20% clip annually. And speaking of the debt ceiling, the federal government only has $109 billion left, which would last at about 2 weeks. So they're going to have to raise this debt ceiling. This is the amount of money that they have to spend. It might be 6 weeks or so because income taxes are coming in. April 15th was tax day. And finally, we have silver deliveries next week. So we'll cover that next week.
Rafi Farber discusses interesting technical indicators in the silver market. He suggests that the broken down trend since the silver squeeze has established support at the 50-week moving average and a 90% retracement of the entire bull market from the lockdown lows to silver squeeze.
In the meantime, interesting technical indicators that we have confirmed is that we have a broken down trend since silver squeeze. It has broken through as of, looks like October, November 2022, and we have established support at the 50-week moving average. But it looks here from the medium term, from the 2020 bottom during the lockdowns, or near it, right? We have what looks like a 100% retracement. Depends where you want to count the bottom. If you want to count it all the way down here at the panic bottom, fine. So you could say what looks like a 90% retracement of the entire bull market from the lockdown lows to silver squeeze. So it looks like the cyclical bear is over, and we are forming what looks like a technical triangle. Is that a thing? I'm not a big technical analyst, but yeah, it looks technically bullish and secure to me. And you can see the 200-week moving average. It hasn't really moved much at all for the last 5 years, and there's going to be a breakout here, I think, when it breaks out above the 200-week moving average. Is For Silver Mines right for you? Ask your broker today.
Rafi Farber discusses the open interest in silver and its impact on price movements. He also provides insights on accumulating speculative positions and options in the short term, recommending physical stacking instead.
Side effects may include owning stock in a mining company. So here we have the first slide. This is the open interest in silver, and that boxed area shows what happened last time open interest fell from around where it is now, 160,000, 165,000 contracts open. So we here see a fall about from 165 contracts to about 140,000 in about a month. And that really took the price down from, what was it, about $27, $26 to eventually about $21 or a little bit below. That was a serious decline. It was hard on the silver bugs, and the fact that open interest has not fallen despite the price retracement over the past few days, and it has only climbed, is a little bit worrying that some of the longs are going to get squeezed out by the shorts. It might not happen, and this is all short term anyway. In the very short term, if you want to accumulate speculative positions and options, I wouldn't recommend that at this point. But for physical, it's not really going to make much of a difference, because if the spot price falls, premiums are going to rise. They're going to pay the same price anyway. So if you're looking to stack, keep doing it. If you're looking to initiate paper positions, I would hold off until probably after delivery day next week. In hindsight, it could be commercial mortgage-backed securities, it could be auto loans, it could be anything. But once it happens, we will know that gold and silver, but once it happens, we will be in the final round of money printing of this monetary system. That is my belief. That is my conviction. Or it could be something as stupid as the debt ceiling, where maybe one side thinks that if they force a default for one day, they will force the other side to capitulate, and then from there, the entire pyramid could collapse, and who knows? I don't think that's going to happen, but if it did, I would laugh, because what else can you do in such a situation? We know it's all coming down anyway. It may as well come down for a stupid reason like that.
As we come to the end of this video, I hope you found it informative and thought-provoking. If you have any thoughts or questions about the topics discussed in this video, please leave a comment below. Don't forget to like and subscribe to stay up to date with our latest content. See you in the next one.